Hey, welcome everyone. I'm Ted Erhart. So my professional focus is retirement planning for individuals over 55. That's what I do. Today I want to weigh in on a very common retirement topic, that being the percentage of income you need to replace once you retire. There are a lot of articles on this, but in practice, I generally find them coming up short in providing people with any actionable takeaways for honing this into their personal circumstances. So today, I just want to share with you my experience working with real people and one of the simplest ways I've learned to assess how much a particular individual or a couple need to retire happily. Let's get into it. Now, if you do some searching online, most of the articles talking about this subject will tell people they need to replace about 80% of their pre-retirement income. So the logic is, as you're working, typically you have a whole bunch of deductions out of your pre-tax income, 401k deductions, healthcare deductions, and so forth, and thus you only need to come up with about 80% of your pre-tax, pre-retirement income. I don't think this logic is totally flawed. It's really just more of a rule of thumb, but I found there's a much better approach for figuring this out as it relates to you as an individual. So early in my career, I wasted tons of time having people go through budgeting exercises and trying to estimate what they're spending now versus what they're going to be spending once they ultimately leave their job. And what I found is the budgets people were giving me oftentimes deviated significantly from what their current income was. So for example, several years ago I met with a couple and we went through a budgeting exercise. We're trying to estimate their retirement expenses on a monthly basis, and the figure they gave me was around $4,000. So I wanted to cross-check this against their current take-home pay while they were still working. And when I looked at their pay stubs, they were bringing in about $8,000 per month on average. So these folks, they weren't 20 years out from retirement. They were about a year out. So there was a huge discrepancy between what they were earning when they were meeting with me versus what they were going to be living off of in just 12 short months. So this meant that either they presently had a huge monthly surplus, meaning cash should have been stacking up, or they were significantly underestimating their spending needs. Now, I've been at this for about 15 years, so I've learned some tricks along the way. The ultimate test to determine if someone has a balanced budget or a surplus is basically to look at their bank account. Is their bank account trending up, or is it trending sideways? I would say that 4 out of the 5 households that I talk with, that I meet with, and so forth, have a balanced budget. That is, cash just tends to trend sideways. That means that whatever comes in tends to get spent. It's a balanced budget. Maybe in 1 out of 5 cases do we actually see where cash is accumulating, which means someone has a surplus, or in other words, they're spending less than what is coming in on a monthly basis. In the folks that I mentioned earlier in my example, they told me they only needed $4,000 per month to live, even though $8,000 was coming in. Well, when I checked their bank balance basically over the last 12 months, it was trending sideways, which means they were spending all $8,000 that were coming in on average. And when we ended up taking them through the retirement planning process, that was the number we used for our monthly target. So what's the takeaway here? Well, again, coming from someone who's got about 15 years of experience working with real people, what I found is the vast majority of individuals and couples need to maintain about 100% of their pre-retirement take-home pay to do all the things that they want to do. So I can rephrase that. Most people want and need about the same amount of cash flowing through their checking account on a monthly basis when they retire as they had in the years leading up to retirement. And when you think about this, it makes sense. People naturally shape their lifestyle around the amount of cash that actually ends up in their pocket every month. I already alluded to this earlier, but a big mistake I see people make is believing that once they retire, that somehow magically 20 to 30% of their living expenses are going to go away. In practice, that just isn't what happens, at least in all my experience, especially for those who are in their early 60s and are still healthy. No one comes into my office and says they want to retire and sit on the couch all day every week. It may be true that spending tapers off much later out in retirement, but in that first decade in particular, in my experience, lifestyle expenses tend to be almost identical to the years immediately before retirement. So if you're doing some planning and you're struggling with this question, how much income am I going to need to replace once I ultimately leave my job? A great place to start is by assessing your take-home pay that you're generating monthly right now. Again, in my experience, the vast majority of individuals basically want to maintain the same level of spending that they've grown accustomed to in the years immediately preceding retirement. But look, hey, I hope that was helpful today. Retirement planning for individuals 55 plus, that's what I do. So if you're interested in a conversation, no cost, please feel free to reach out. Again, thanks for watching. I hope we'll see you in the next one.